Hello and welcome to Pharma Television News Review here in Munich at BioEurope 2010. On this show, I have Francesco de Rubertis, who is a partner at Index Ventures. Welcome to the show.
Thank you. Nice to be here.
Nice to have you here. Index Ventures, obviously a venture capital firm. Tell us about what funds you have. Obviously, you were founded back in the mid-1990s. Tell us about the types of funds you've got and which ones are actually active right now.
Right. So we've got a number of funds. All of them are mixed funds. So we invest both in biotechnology, life sciences, and information technology. And actually, I would say that information technology is a bigger share of the whole equation. And every fund has got an early stage venture capital strategy. So we go in really very early stage, seed financing, early stage Series A financing. And then since a couple of years, we have also started a second line of the business, which we call Index Growth, which has raised a fund, the first fund, Index Growth 1, that we raised back in 2008, with a strategy both in information technology and life sciences for investing in mature companies. Mature companies can be public companies, can be late-stage private companies, can be companies that are generating a cash flow, so companies more in the service businesses, in the medical device businesses, but the definition of late stage. And we've been active across Europe and the US. And I would say historically we've been 80% Europe focused, 20% US focused, and probably over time we are increasing the trend towards the US to rebalance a little bit better.
So over the years, Index has been obviously active. Has the character of the types of companies you invest in changed?
Yeah, that's a great question, actually. Absolutely. Our business model, very fundamental, the business model that we think has got a chance of success is really the one that adapts to the environment. So we started up, many years ago with, and I'm talking, of course, only of the biotech part of the equation of our investments, with, business models that would carry the company throughout, the long run. So starting the company with a big vision, big ambitions, many products potentially, fully completed management team, and actually out of that initial class of investing style or focus, Genmab has been clearly the company that has gone the furthest along. Over the last few years, of course, a couple of things have happened. Cost of capital has clearly changed. So, the later stage rounds of financing, the co-investors scene has been evolving around us. And so you cannot really discuss in a vacuum, or you cannot really think about business models in a vacuum, but you have to cope with the environment and the ecosystem which is around you. So over the last few years, we have really, alongside those kind of fully shaped companies, which however have to be based upon disruptive platform technologies, otherwise it's difficult really to build them for the long term, alongside those disruptive platforms, then we are really focusing on more embryonic companies which are reset around one single asset or a couple of assets. So we've changed the vision or the investing model of vision-based investing model into asset-based investing model, with the idea that after we do know that indeed the asset that we have decided to back with a different kind of investment, much more focused around the project, with a variable cost ratio to fixed cost, which is very different from the first generation investment model that we were going after. Once we know that that asset indeed is a real value driver, then we always have the two choices that we can make. Either we go and revert into the full build-out model that we were doing at the beginning, but now with an asset that represents a tool to build. Cost of capital is lower. You can attract a management team that can run the show for the long term. You can even go public. So that is one option that the asset companies have got after a while, or simply once the asset is at a maturity level which already can attract the attention of the big pharma guys, then it's also an option that we have at that stage of exiting the company at that stage. So that has been the evolution of our business model, from fully shaped from day one into an asset model on day one, with the option of going full development only at the early phase 1, phase 2 stage. That has been the evolution of our business model. At this point, however, I would like to emphasize that still, when we see companies at the very beginning, on day one, that are based upon a disruptive technology value proposition, that represents the internal hedge of risk. So those companies are companies that we would love to find, but you don't find those companies every 6 months or every year. So probably I would say of the 100% of our investment portfolio, there is probably 20%, 15%, 20%, which is in those long-term winning companies, we hope in winning companies.
Right.
And the 70, 60, 70% in single asset companies that, half of which will evolve into fully developed companies and half of which will be exited earlier, taking out the failures, of course, the technology failures.
Yeah. So you talk about the character of the companies themselves, and you talked about the environment. Of course, venture capital firms themselves have changed. And how important, I suppose it's always important, but how important is it today to get in alongside the right venture capital firm alongside you? Because one thing we all know is that all the backers need to be aligned. If you've got misalignment amongst the investors, you can end up with problems. So
very, very important. You're totally right. It's very, very important, and not even the type of investor. So we know who are the investors that have been there for a long time, that have got the experience of building companies. But it's also very important, at which stage in their life cycle they are in their funds. If I'm aligned with another investor in going and backing a company, but I am in the early years of my fund's life, and the other investor is in the late years of this fund life, obviously that is something which is going to cause misalignment of agendas a couple of years down the road. So even there, so it's even beyond the right firms, as part of the DNA of the startup company or of the company, but it's also the right firms at the right moment. And in Europe, we are facing a difficulty of the ecosystem, which is there is probably, between 5 and 10 VCs which are really very active in the biotech space, very active with the experience of, 10, 15 years of investing experience. But that's it. It's 5, 10 venture.
So it's a small club.
Very small club. And, from a certain standpoint, it's good because you are in the middle of a platform that see most of what happens in Europe. But it is a limitation, though, because, of course, when you need to support the company the extra mile, or when you need to raise funds for another of your companies, there is only so many people that you can revert to. We'll see if the US guys come more and more into Europe. There are a couple of funds that are pretty active here in Europe, and there are more that are showing their interest in Europe. But at the current stage, it's a very small group of people that really are balanced and equipped to make venture capital investing in Europe in biotech.
Right. Now, of course, the other thing that's changed over the last few years is the number of corporate venture groups of major pharmaceutical companies. And it's more or less now like every pharmaceutical company has to have at least one venture arm. How much has that changed things for yourselves in terms of investment? And what do you see as positive and what do you see as negative as a result of those firms coming in?
So actually, I think it's a great thing, the fact that these corporate venture funds have come into the loop, especially in Europe because of what I was saying before. So in the 10, 15 funds that I was referring to before, I also include the 2 or 3 major corporate venture funds that have been active for a while. They've got really key role in the system. They have a key role. First of all, of course, the access to diligence that that they can provide to the syndicate, that is obviously a very important asset for us. The downside of having these corporate venture funds potentially is always the fact that, there is always a silver lining, right, between strategic interest and just pure financial interest, which is aligned with the existing venture capitalists. So those are things that need to be clarified really very well in the beginning at a corporate governance standpoint in terms of access to information and voting mechanisms. But the key thing is that those tools can be put in place to make sure that there are no issues. And we have great relationships with 2 or 3 corporate venture funds which are in our companies. The GSK, the Johnson & Johnson funds are clearly funds with whom we have been working a lot, and we hopefully are going to keep on working going forward. And so hopefully we can only desire that these funds become more and more active in Europe because they have a real role to play, even more so now that there is a partial vacuum in Europe.
And these funds are also being used alongside options that they may have on certain licensing opportunities, particularly when it comes back to these platform technology-based companies. So we're seeing more of that. So So corporate venture funds coming in alongside yourselves, but on the back of a potential deal that could happen downstream. Is that type of deal the dream deal for you guys?
I'm not sure. I mean, I really like the corporate venture fund guys to come in with an equity interest on the basis of their excitement for the technology, and their excitement, of course, is not it's not empty of the interest that the pharmaceutical company will have at home. But we feel, and we really index, feels that these option deals with pharma, and actually there are some pharmaceutical companies that have clearly set up funds with option links to other venture capitalists, can become pretty dilutive to the growth of the company. Now, they can be downside scenario coverage kind of tools. But in terms of upside, there is a compromise on the upside. So if there is a reason why to compromise on the upside, sure, that can be strategic. But in principle, when we invite corporate venture funds to invest in the companies that we are looking at or that we are investing in, we really like them to come along with exactly the same tools and agenda, where possible, than we have, bringing to a different level the discussions with the corporate mother companies. And we have a couple of companies, Molecular Partners, for example, is a company in which we have Johnson & Johnson as part of the genotype of the company, and we're very happy with that relationship. There is a very clear separation of intent between the JJDC, Johnson & Johnson Development Corporation, sure, and the mother company. But clearly it's great to have Johnson & Johnson as part of the genotype, because they can help us a lot strategically think how to grow the company in a way that is compatible with today's pharmaceutical environment.
And then the other thing, of course, is that pharma companies will buy biotech companies. And that's probably the only real exit these days for you guys, because obviously the IPO market is more or less gone. Maybe some residual play out there. But so these corporations are very, very important for your returns.
Well, absolutely. I mean, that is really very strategic for us to make sure that we understand as well as we can possibly understand how these corporations think, what are their urgencies. And when you discuss with pharmaceutical companies, everything or many things can be of interest to a pharmaceutical company. The question is really making sure that we understand what are really the priorities and the urgencies for these pharmaceutical companies. So yeah, I mean, we spend really most of our time and our lives trying to interface with pharmaceutical executives to really try to understand how their companies and organizations are evolving, and so how we need to adapt. We need to adapt our companies to where the market is, our investment models to what kind of companies can be built. And since the beginning of time, of course, success in biotechnology has been associated really with capacity of adaptation and evolution, morphing more than being right in the first time. If you look at the biggest companies on NASDAQ, on biotech NASDAQ, if you backtrack them on day one of their history, most of them were very different companies than what drove their success afterwards. So adapting and evolving and morphing is the key game. And this is true not only for pharmaceutical companies, but for venture capitalists as well. So maybe in a few years, we will still be doing different kind of investments. Today, we are focused on this kind of investments differently from how we were focused 10 years ago.
So you're taking less risk?
I don't know that we are taking less risk, but we are investing less cash in the high-risk assets. But I would say we are doing a bigger chunk of our investments in high-risk assets, but with less capital exposure in those high-risk assets. In other words, we have increased, we hope, we'll see over the next few years, but we've increased the leverage that we have on those investments so that the positive outcome should deliver us much bigger returns, and the negative outcomes should eat much less cash out of our funds. We really have rebalanced the cash at risk more than avoiding the risk. The risk is really why venture capital exists, right? I mean, this is really where we have our reason of being, where we have a value proposition, where we can help creating companies. After all, 70% of the public companies in Europe have been started by venture capitalists. So there is a function for venture capitalists, but money at risk, before big milestones or before really you know that you have an asset, that is really where we have changed our strategy and fine-tuned our approach.
Right. Now, traditionally, venture capital look for at least 5 times return on their investment. That's what you hear about. Would you say that expectation has been lowered in
No,
biotech?
I don't think so. I don't think so. Actually, thanks to pharma that is buying companies more aggressively than it was buying before, those can still be estimates that can be real and hopeful. The companies that you build, the companies that you really want to drive independently through major public markets and growth phase and see the company 15 years out, that distance of cash, because cost of capital is so high, clearly takes away the possibility, in our opinion, and as it seems right now, to really plan for 5, 6, 7x. You really need to plan there for 2, 3x's when things go well, sure, but on a large amount of capital. So it's a balance between small amount at higher multiples and larger amounts at lower multiples.
Right. So the IPO market, it talks about the IPO market more or less dried up. But when we look back at the IPO market, even 5, 6 years ago when it was active, it was not going well. Most shares went down post-IPO. Does that mean that because people have been burnt by IPOs, that the chances of an IPO market ever coming back for biotech companies, maybe for mature cash flow companies, which is very predictable in terms of more predictable, that we will never really see a return because in the end, to IPOs, because in the end, isn't it much better when a corporation comes and buys the shares of the company? You don't have to worry about the shares after the event.
No, it's true. You're right. Now, it depends on the ambition of the management team. So there are management teams that, they decide on day one when they get together to create a company that they are going to create the next big company. And, there are some of them that are going to become the next big companies. So for those kind of ambitions, the IPO is necessary, is on the critical path. Now, the question, you're right, probably even in 2006 when there were IPOs, there was a class of companies that was that had been starved for the previous few years. So anything, even very early, came out on the market, and those are the companies which are more prone to failure right after, and so share price goes down. So probably IPOs are going to be more selective. You need to be a more mature company probably to go public, even though there is always exceptions, right? I mean, there is the earlier stage asset that is specifically uniquely de-risked as a function of many correlate markers that could probably be safe enough to be presented to the IPO markets. But you're right that by strategy, the IPO cannot be used as a building tool early in the story of building. You need to plan for maybe $50 to $100 million of private financing before the airplane can come to a certain height, which is high enough to fly on the public markets. Sure. So it is changing. You're right.
Okay. Now, finally, just looking at the health of the biotech industry, we're all aware that funding is less available, and even your own strategy means change in strategy means that some of these companies are not going to get funded, at least by index ventures. So, for somebody who's been in that game for a time, like yourself, what is your prediction for the future? What sort of landscape can we expect for biotech? Let's say just here in Europe.
Yeah, so I think there is one consideration, which is the unmet needs, unfortunately, because these is diseases, but they are there. They're not going to go anywhere, right? Unfortunately. So because that is the ultimate reason why the biotech industry exists, there will still be the need and the incentivization to really discover new drugs. Now, how that discovery of new drugs is going to happen, that is difficult to predict. My feeling, which derives from the trend that we are observing, is that the very high risk early stage discovery of drugs, which is really the one that can move the frontier of the unmet needs away, is happening less and less inside the biotech industry, as you highlighted. So I think a trend that I'm seeing is that academia is getting closer to pharma with creation of departments which are more early stage analysis of mode of actions, which are clearly interesting from a medical standpoint. And so, applied pharmacology, applied translational medicine, university, which does not live on a straight line. So, even risky mode of actions, even if it takes 3 years longer than planned, inside a biotech company it can be disastrous, but inside an academic environment it can be more buffered by the organizational system. So I think universities may play a bigger and bigger role in that incubating phase of new drugs. and that link will probably become a stronger link with pharma. So the biotech industry in itself will be under pressure, I think, in between the universities and the pharma, even though, of course, university is not really well suited to interface with pharma. So biotech could become a sort of interface infrastructure or system between university and pharma, as it should be already today, but even more so to really finance early stage drug discovery inside the academic environment. So that could be one way in which it could go.
Francesco, thank you very much indeed for coming on the show.
Thank you very much.